Ever wondered why financial regulations matter so much? Picture a world without them, a financial Wild West where the markets are as unpredictable as the weather, and consumers are left to fend for themselves against unscrupulous business practices. A world without financial stability, where economic crises could strike at any moment with devastating effects. Sounds chaotic, right? Financial regulations serve as the unsung heroes in this scenario, maintaining order in the financial markets and providing a safety net for consumers. They promote market integrity by deterring fraudulent and manipulative practices, ensuring that the financial system operates in a fair and transparent manner. These regulations also play a crucial role in safeguarding financial stability, preventing the domino effect of financial crises. Behind the scenes, regulatory bodies work tirelessly to enforce these rules, their vigilance acting as the backbone of our financial system. Now that you understand why financial regulations are vital, let's delve into what they entail. Financial regulations may seem complex, but they can be broken down into simpler terms. Let's take a moment to unravel these intricate constructs and shed light on their true essence. First off, let's discuss capital requirements. It's a term you've probably heard thrown around in financial circles. In simple terms, capital requirements refer to the amount of money that banks and financial institutions need to hold in reserve. Think of it as a safety net. If a bank makes risky investments and things go south, this safety net can prevent the bank from collapsing. This protection not only secures the bank but also safeguards the money of the bank's customers. Next, we have fiduciary duties. This term refers to the ethical obligation of one party to act in the best interest of another. In the world of finance, this typically applies to financial advisors or brokers who are tasked with managing someone else's money. These individuals must put their clients' needs before their own, ensuring that they make decisions that will benefit their client first and foremost. Lastly, let's talk about risk management. This term might sound intimidating, but it simply refers to the process of identifying, assessing, and controlling threats to an organization's capital and earnings. These threats could be anything from financial uncertainty and legal liabilities to strategic management errors, accidents, and natural disasters. It's like a game of chess, where each move is calculated to minimize potential losses while maximizing gains. Using real-world examples, consider a situation where a bank has invested heavily in a volatile market. The capital requirements ensure that the bank has enough reserved funds to weather any potential losses. The fiduciary duties ensure that the bank's brokers are acting with the customer's best interests at heart, not risking their money recklessly. And the risk management ensures that the bank has strategies in place to limit any damage if the market does indeed crash. With these basics in hand, we can now explore how these regulations are formulated. Ever wondered who makes these regulations and how they come into existence? Well, the process is as intricate as the regulations themselves. The journey of financial regulations from inception to enactment is a fascinating dance of collaboration and compromise involving a diverse set of players. On one side of the spectrum, we have the regulatory bodies. They are the architects, the masterminds behind the blueprints of financial regulations. These bodies include central banks, securities commissions, and other agencies dedicated to financial oversight. Their role is to identify potential risks and vulnerabilities in the financial system and to propose policies to address them. Then we have the policymakers. They are the legislators, the ones who shape, refine, and ultimately pass these regulations into law. Their task is to balance the need for financial stability, economic growth, and consumer protection. They scrutinize the proposed regulations, debate them, and sometimes modify them based on their understanding of the market and the needs of their constituents. And let's not forget about the financial industry itself. Banks, investment firms, insurance companies, and other financial institutions all have a stake in this process. They are often asked to provide input, and their feedback can influence the final shape of the regulations. Their expertise is invaluable in ensuring that the rules are practical, implementable, and effective. Once all these voices have been heard and all the considerations weighed, the proposed regulation is finalized and enacted into law. But that's not the end. The regulation is then monitored and reviewed periodically to ensure it's working as intended and to make any necessary adjustments. So, you see, the making of financial regulations is a complex process, a delicate balance of different interests and perspectives. It's a task that requires a deep understanding of the financial system, a keen eye for detail, and a strong commitment to protecting the public interest. Now you know how these regulations are made, but the story doesn't end there. Creating regulations is just the first step. Enforcing them is another ballgame altogether. Financial regulations are not merely a collection of rules set in stone, but a dynamic, ever-evolving system that requires constant monitoring and enforcement. Enforcement of financial regulations often involves routine inspections. These inspections are akin to a doctor's regular checkups, ensuring the financial health of institutions under their purview. They serve as a preventive measure, identifying potential issues before they become full-blown problems. In addition to inspections, audits also play a critical role in enforcing financial regulations. Audits are like a deep dive into an institution's financial practices. They scrutinize every transaction, every policy, every loophole to ensure that the institution is not just compliant on paper, but in practice as well. But what happens when a financial institution fails to comply? Penalties, often in the form of hefty fines, are levied. These penalties are not designed to cripple, but to correct. They serve as a stark reminder that non-compliance is not just a breach of trust, but a violation that comes with significant consequences. Enforcement is the heart of financial regulations. It ensures that these regulations are not just theoretical constructs, but effective tools that protect our financial system. Without enforcement, regulations would be akin to a car without an engine, good to look at, but incapable of going anywhere. As you can see, financial regulations are a complex yet fascinating aspect of our financial world. So there you have it, a simplified guide to understanding financial regulations. We've delved into their importance, demystified their basic concepts, walked through their creation process, and discussed their enforcement. Financial regulations aren't just for policymakers or financial experts. They're a piece of the puzzle we all need to understand to navigate our financial world effectively. Remember, knowledge is power. Subscribe and share us to help spread financial literacy. Until next time, keep learning.